righty, we're going to go ahead and start. Can everyone hear me okay? Trevor is no longer with the firm, so we have Robert O'Hara. He's pinch hitting today, and he's going to present. First of all, I want to thank Ellen, as always, for coordinating our luncheon today. She does a tremendous job. So when you're leaving today, please thank her, because she is really the brains behind the operation, and we wouldn't be here right now without Ellen. So, and also want to thank the team at First Trust for helping support us today and bringing Robert. So Robert O'Hara is a research analyst at First Trust Capital Management. He's focused on supporting all aspects of the investment research efforts. Prior to joining First Trust, Robert worked as the investment analyst and trader with an RIA in the Southeast, focused on fixed income credit research and portfolio management. He is a graduate of Penn State University with a degree in finance and an undergraduate certificate in real estate analysis and development. He's a fellow CFA charter holder as well. So with that, I will go ahead and introduce Robert.
Great. Can you all hear me all right? All right. So thanks for making it out today to this lunch to discuss private credit with us. Really do appreciate you making time for us on a Wednesday. I know you all are busy. All I want to talk about today is on a one-page piece of paper, two-sided. It's going to take about 25 or 30 minutes, but then I really want to save some time at the end to hear your questions and hear what you guys are thinking about within the space as well, and make this a bit of a conversation. So a bit about me, my day-to-day role. I'm responsible for sourcing and underwriting our investments within private credit and structured credit as far as our co-investment programs. I'm also responsible for the oversight of around a dozen GP relationships where we have primary fund commitments predominantly within private credit and structured credit. And then I assist Brian Murphy, our CIO, on the liquidity analysis and position sizing within our public fund complex. So private credit, it's a broad topic. It's a hot topic, as I was talking to a few of you about on the way in today. And we're going to try to approach it today from a standpoint of starting really at a 101 level. So it may be remedial for some of you, but for those of you who are just starting to get your arms around the space, trying to understand what private credit is, different areas of private credit, hopefully that will be helpful. As we start to peel back the layers of the onion, we'll dive into the borrower's perspective, why borrowers use private credit versus other lending options, and then a few examples of how we're utilizing it within our portfolios today, and then maybe we can have a discussion about how some of you are planning on using it or utilizing it within your portfolios today. So this slide, the ecosystem slide, by no means is it meant to be all-encompassing. These are things that you all are familiar with. Each square in the screen, I'm sure you all either have been pitched an investment in this area, you've had a meeting with a manager that you've maybe invested in this area, or you have allocations in the ground today. But just to run through at a very high level some of the structural features of these markets, these are some of the financing options available to corporate entities within debt financing markets today. Investment grade bonds, just a few high-level structural characteristics. These are fixed rate in nature, senior secured obligations of the borrower, and they tend to spread off of the treasury curve, which has implications today for the way that that curve is obviously shaped. These are obviously investment grade graded. They're the largest borrowers. They have strong capital structures, diversified business models, diversified customer bases, multiple avenues for which they can receive financing. Moving down the spectrum, high yield borrowers or high yield corporate bonds, structurally very similar, right? They're senior unsecured obligations. They tend to be fixed rate in nature. They spread off a treasury curve. Where they're different, obviously, is the borrower profile. So these tend to be smaller businesses. They tend to be more complicated or more challenged capital structures. There's a multitude of reasons why a borrower may be rated below investment grade. The broadly syndicated loan market, a little bit different in a structural sense because these are floating rate obligations that spread off the front of the yield curve. Domestically, they're going to spread typically off a base rate called SOFR, which I'm sure we're all familiar with after the transition from LIBOR, which is still underway as we speak. And there are senior secured obligations of those borrowers as well. All three on the top we label public, but really what I mean is liquid. You can trade on a whole loan basis, broadly syndicated loans. You can trade on a whole loan basis or on a whole bond basis. High yield bonds, and obviously you can trade investment grade bonds relatively easily with limited friction in and out of the trade. Now, I wanted to put the middle market leverage loans and middle market CLOs box just up and bifurcated by the dotted line. I quickly found out I have no power in this organization because the folks at the marketing department are the ones who run the show, and they said it has to fit the formatting rules for our firm. So middle market leverage loans, there are middle market investment banks, regional investment banks, boutique investment banks who syndicate loans at a smaller end of the size spectrum. But the reason I put it down in private when I had to choose was because middle market CLOs have become synonymous with a new asset that's sort of come on the scene over the past few years, a direct lending CLO. So where the underlying collateral in a traditional CLO is a broadly syndicated loan to a Fortune 1000 size business, and it's a liquid underlying. And with a middle market CLO, you have a moderately less illiquid underlying to a smaller business. With a direct lending CLO, the underlying obligation is a directly originated transaction that you can think of as this direct lending, which is probably the largest area of private credit. If you have dollars in the ground today within the asset class, that's likely where you have it. What is direct lending? Let's just demystify that for a minute. They're, again, senior secured obligations, or generally senior secured obligations to middle market businesses that tend to be sponsor-backed entities. So they're owned by private equity firms. The reason that a private equity firm uses them is to finance LBO activity. That's the predominant reason that you'll see direct lending used. It's very similar in a use case for a middle market leverage loan or a BSL. And private equity firms favor them for a variety of reasons. And they make a cost-benefit analysis that we'll get into when we discuss the borrower's perspective between the advantages of going the direct lending route, the private credit route, versus the leverage loan route. And hopefully we can try to get you inside the head of that and help you try to understand why you'd get that, maybe make that decision over one or the other. But first, before we jump into that, this is a slide you've probably seen or a graph you've probably seen in any one of the financial publications that you follow. It's a graph that, or a chart that if you've had any managers in your office that have been showing you anything within private equity or within private credit, it's probably something that you've seen. This is LBO activity since 2010 through the end of 2022. It looks really flat, right? Nothing's changed in the past 12 years. So in 2021 and early 2022, we saw an explosion in deal activity. Financing rates were very low. Valuations were high. The public markets were open from an exit opportunity. You saw a lot of private equity dollars deployed during this time period. And financing that activity was a combination of private credit and leverage loans. So what I'll say before we jump into the implications of this is that through time, as you all are aware, private credit and leverage loans finance different parts of this ecosystem in different proportions, and it's sort of shaped differently through time. What may have been a private credit deal in 2011 might not have been a private credit deal in 2018. So understanding the different vintage and the different implications for that, and understanding what your exposure is through time, and how companies were thinking about utilizing the asset class is important as you start to make investment decisions. Especially so as we arrive at the 2021-22 period, because this coincided at a time with record high valuations and multiples within private equity. I'm sure you all have seen the headlines about, I think the greatest area of excess that we've seen is sort of the software-based or SaaS businesses within the venture ecosystems, and the multiples that were assigned to revenues in some of those areas. There was certainly pockets of excess in control stake LBO activity, and private credit and leverage loans were the financiers for a lot of that activity. By no means am I saying that every deal originated in 2020, 2021, or early 22 was a bad transaction or that is going to have implications, but it's certainly plausible that if valuations have corrected in certain parts of the ecosystem by 40 or 50%, you're going to see elevated impairment, you're going to see elevated default above what we've witnessed over the past 5 to 10 years. You're going to also likely see, depending on what your covenant package looks like, depending on what your collateral looks like, and depending on what the value of the underlying business looks like, differing loss severities, which can have an immense impact on what your actual return ends up looking like within some of these structures. So how does this impact some of your investments today? I just picked out 3 kind of areas that we have exposure to. I'm sure some of you who are investing in the asset class have exposure to. CLOs are an area that have implications for this, right? If you have a CLO that was investing during one of these time periods, or during this time period, or had a reinvestment period during this time period, it's likely that there's loans that were originated during that time period in the CLO. So what are the implications for that? What tranche of the CLO do you own, and where is it pricing today? And do you believe that's reflective of where the actual underlying loan value is based on your assumptions and your estimation of where default rates and loss severity should be? So walking through that, right, if you think default rates are going to explode in year 1 or year 2 because you're more pessimistic about the next 18 to 24 months, and you think during that period recovery rates, so the dollars that you receive back in the door on a loan that you made after a restructuring are going to be lower, then what are the implications, right? How does that affect your investments today? And that's something you should be thinking about if you have some of these investments. It's something we spend a lot of time on. Evergreen credit investments. So if you're investing in funds that have quarterly in, quarterly out, a typical hedge fund structure, you've seen a lot of private credit firms that are trying to seek more permanent capital sources from some endowments and foundations seek to raise money this way through evergreen vehicles. Those vehicles, if they had been investing or operating during this time period, especially if they saw a period of rapid growth as people allocate to the asset class during this time period, the implications for that over the next few years is something you should be considering, especially within those structures. CLOs are incredibly much more efficient in terms of how they price, and they're tied to market mechanisms that are on the liabilities side that make them more efficiently priced than what you'd necessarily see in evergreen funds. It is not uncommon for private credit managers within evergreen funds to not necessarily mark their loan portfolio the way that you would see within one of your bond portfolios on the investment grade or high yield side. So it's something you have to be aware of. It's something you should be aware of as you invest in this asset class and find the right partner in this asset class to invest alongside. Drawdown vehicles, this is another area. If you have QP clients, this is an area where I think you probably will be spending a lot of time. We invest in private credit predominantly through drawdown vehicles because we have a set date where they have to give us our money back. It's an easy thing to understand. You usually understand that characteristic with the bonds. It's simple, but it's important. It forces the lender to not just amend and extend and appease these borrowers, but actually get them to refinance a loan or face some sort of restructuring. So that was a lot of information. I just want to leave you with not every transaction that was originated in 2020, 2021, and early 22 is a bad transaction. There were pockets of excess. There are still today. Just be aware of the underwriting, be aware of the loss data, be aware of your own scenario analyses that you're running at your firms, to understand the implications of this on your portfolios. The borrower's perspective. This is my favorite slide because I think it really boils down if you were a private equity firm, and maybe some of you do work at a private equity firm, why would you use private credit over a leveraged loan? Well, private credit has a lot of advantages for borrowers. Assuredness of execution is probably one of the most important. I'm sure a lot of you followed in the back half of 22, leveraged loan market effectively shuttered. The largest money center banks in the United States were stuck holding loans that they were planning on syndicating that they were no longer able to move. The biggest examples of this, I'm sure you all have read about, are Twitter, Citrix, Brightspeed. These banks got stuck holding tens of billions of dollars of LBO financing on their balance sheet and were forced to cut these bonds by 5-10 points at issuance just to clear their deck, and took large losses going into the end of the year. That effectively led bank risk departments to take into account the macroeconomic scenario and their own lending programs and new lending programs and pull back from lending into new deals or pull back from underwriting new deals. Private credit, because of the nature of their capital, offers an assuredness of execution that you don't necessarily see in the public leveraged loan market or the BSL market. By flexible structure and terms, I mean that private credit functions, the two most common you'll see are a first lien, and sometimes you'll see a second lien come on top of the first lien in sort of a mezzanine transaction, or you'll see a unitranche. That's just a fancy word for a bigger loan that you can then splice into a first out piece and a last out piece. So a senior loan and a more junior loan within a 1L senior secured loan. So those are the two most common structures. It's a way for private equity firms to optimize their capital structure and their cost of capital at acquisition, which you don't usually see within the leveraged loan market. The last 2 points are some of the most important, I think, from the borrower's perspective. Just put yourself in the shoes of a private equity firm for a moment, and imagine you go the leveraged loan route, you go the syndicated route. You may have 50 or 60 underlying borrowers. The borrower profile is going to be a CLO, an insurance company, other large asset managers, bank loans, buyers of bank loans, and banks. And when you think about that and the fact that this asset is liquid, this loan is liquid, while you may have 50 or 60 lenders to begin with, if you experience a period of stress, if you start missing budget and your loan trades down into the 80s, into the 70s, and that par lender, the person who made you the loan at par, is now selling the loan in the secondary market because they're in a CLO structure and it got downgraded, or they see stress and they don't like the way the bond's printing on a client's statement and they sell it. Now you all of a sudden have a stressed or distressed lender that you didn't choose, you didn't syndicate the bond to at the beginning, who owns your loan. And if they amass a large enough position in the loan, they can cause some real problems for the owners of this business if they run into trouble. In a simplified ownership base, in a club transaction or in a bilateral negotiated transaction, a private credit firm is able to be one to five counterparties for that lender or for that borrower instead of 50 or 60. That also has important implications if there is an amendment process or anything that needs to be changed in the loan documents along the way. And the last point, more efficient use of company resources. Not hard to imagine. If you guys just bought an industrial parts manufacturer in the Midwest and that management team has just crushed it, ripped the cover off the ball for 10, 15 years at this business, is it the best use of time to send them on a 6-month roadshow through New York and Richmond and Chicago and LA? Like, it's a much better idea to probably keep them running the business in the Midwest and sending in a private credit firm or 2 or 3 or 4 to get to know the management team there. Also, will that management team present well? Will that management team show up to a New York board meeting and be able to secure a syndicated loan to 40 CLO managers? It has implications for how these loans price. You obviously don't get it for free. Private credit, no secret, it is more expensive. The spread is wider, and the fees are higher. Not everyone can access the leveraged loan market either. The largest businesses, the largest companies that are purchased can access the broadly syndicated loan market and the private credit market, which drives private credit to be more competitive. But there are pockets of private credit where they don't necessarily have the public financing option, which allows you to drive terms and rate and security and structure a little bit more. Okay, where are we spending time today? So we have been spending a lot of time in hard asset-based lending over the past, call it 6 to 9 months. This is an area of private credit where, just to give you an idea of the borrower profile, these tend to be businesses that are experiencing a period of capital inadequacy, either structurally or as it pertains specifically to that business. So the best example of a structural reason, a lower middle market or middle market energy business that was traditionally bank financed, and because of activist pressure on the bank, because of shareholder pressure on the bank, they've had to pull back or cut their programs within certain non-ESG compliant areas. And that business is a strong, profitable business with lots of assets that is now unable to, and very capitally intensive, that has now lost a primary source of lending. Another reason that someone may use a hard asset-based lender or an ABL lender is if they're experiencing a period of transition. COVID's a great example. If you're a retailer and you were in COVID and all of a sudden people stopped coming to your store, if you're a hospital network and you were no longer able to do the higher cost surgeries and you had to do more of these lower margin treatments around COVID, you're experiencing a period of transition that causes other lenders to think twice about lending. So how do you get comfortable? These don't sound like great businesses. Why would you lend to them? You get really comfortable with the collateral package. What these all have in common is that they have assets that are able to be valued, and you get security in your first lien claims on the collateral package. And it's very simple. What you do is you draw a fence around what those assets are. You monitor them on a monthly or quarterly or annual basis to ensure that the assets are performing and that they're of the same quality as of the initial underwrite. And you appraise them at a net orderly liquidation value basis. So you assume that you have to liquidate those assets over a short period of time. And that's a relatively bottom bucket price for that business's assets. It's not necessarily an economic price. But you say to yourself, okay, I'm willing to make a loan at 80% of the value of that net orderly liquidation price. So I'm willing to give that asset value, that net orderly liquidation price, a haircut of 20% and make that loan. Then you get to make a loan to a business that is secured by hard assets that you are very comfortable with the collateral package in a downside scenario in the event that there isn't repayment at an above market rate, because these are businesses experiencing transition or capital inadequacy or simply less competition to lend to them. And the exit here is defined. Right, so either the borrower refinances the loan after they've experienced the transition, they sell the business because it's a private equity-backed firm and they sell it to someone else who refinances the loan, or the business defaults and you liquidate the collateral. So the defined outcome space is something that we spend a lot of time on. Select direct lending, this should probably be intuitive based on our last couple of slides, but we spend a lot of time thinking about areas of direct lending that actually do real underwriting, that aren't just a service provider for private equity, but look at the actual fundamentals of the business, look at the actual cash flows of the business, look at the ability for them to be refinanced, understand what the outcomes and the scenarios may be as you lend to that business. So what do we look at? Some tools for you guys to use as you kind of evaluate managers of your own. Some things we look at are they agent on transactions? So agency is a term used that allows them, if you're an agent on a transaction, it means you drive the process. So if there's ever a default or a covenant trip, you're the lender that has been elected by the other lenders to speak for them. You're the one who decides what the amendment process looks like, what fees you get from the amendment process, or if you put the company into restructuring. So is the borrower or is the lender that you're aligning with agent on transactions that they're lending into? Do they have a restructuring team? That's the biggest tell. Do they have someone on the team that could restructure a company? If they don't, they are likely going to be more on the appeasement end of the spectrum. So something to think about, just 2 quick things that you can use as you analyze these transactions or these managers. Areas of excess, or areas that we're a little bit more cautious about today. ARR-based lending, that's annual recurring revenue-based lending. You saw a lot of that in the software and tech-enabled business space. You've seen valuations correct a bunch there. Some people are lending into that space thinking it's a great time to push rate. We've always been a little bit more cautious about what the actual fundamental collateral is there, what the ability to repay if the business plan doesn't go well. And you've seen recently, I'm sure a lot of you have been following within software, this phenomenon of shelfware. So at AWS and Azure, companies pay for shelf space the same way you would at Kroger or Publix. You get like essentially a debit card if you're a software purchaser at these large corporations. So if you redeem your dollars from one software provider, you have a spend set for that year. The spend is rolling off, and software will likely hit a hardening cycle, to use an insurance industry term. So we're a little bit concerned there, or cautious, I should say. And then financial asset-based lending. The quintessential example of this is you're a fintech platform, and you've scaled your business largely through venture financing and equity. So you have a very equity-intensive capital structure. You make consumer-oriented loans, either a buy now, pay later, or personal loans, or what have you. You decide at a certain point, probably between Series E and Series B, that you would like to use a more efficient form of capital to grow your business that doesn't dilute your current shareholders. So you look for a private credit solution. What that typically looks like is a revolving credit facility that provides an advance rate or a haircut to the dollars that you put out the door on loans into your ecosystem. We're cautious for a few reasons there. A lot of times these lenders will come to you and say they're asset-based lenders, that they have assets on the other side of their loans, but when you look at what fundamentally is there, it just ends up being more loans. And if you look at what those loans have from a security or claims perspective, they're typically unsecured. So they're really driven by what the loss severity, what the default rates have been on a historic basis. And given that these are relatively nascent businesses with fairly lean underwriting teams, sometimes tech-enabled or AI-based underwriting systems, which are real, but have gone a long way over the past 4 or 5 years, and there's likely loans in those portfolios that maybe don't have as stringent underwriting standards as you would like to see. But at the end of the day, they just haven't been tested in a cycle. We haven't seen those loan portfolios go through a cycle. And your exit option is completely predicated on someone else refinancing you. So with bank financing being a traditional exit for someone at the larger end of the financial asset-based lending ecosystem, and that being in question today, it's something that we've become more cautious on. So this is an example today of one thing that we're doing, and this is where actually something we have in the portfolio today on our asset management side. So this is a direct lending CLO that they've worked on. I've redacted the names, but we're all friends here. Unfortunately, this is being recorded, but I can talk to you after if you're interested in this. So the securitization process looks very similar to what you'd see in a regular way CLO or a middle market CLO. The underlying collateral pool looks very similar, 100 to 300 loans. The underlying exposure may vary depending on which manager you align with, and the tenor of the transaction and the shape of the transaction structurally will look very similar to a reinvesting style CLO and its weighted average life and its reinvestment period. So what is it? How do you do it? We work with a few partners on our end to identify a private credit manager and underwrite them from a bottom-up basis. It may be someone that we already work with. It may be a new manager. And we do our full underwrite, which usually takes around 8 to 12 weeks, where we work to fully understand the investment process, underwrite the team, underwrite their portfolio management and portfolio construction, underwrite their loss data, underwrite their loss severity, and really understand what they're doing. Then typically we locate a warehouse provider, generally a money center bank or a regional bank, that provides a facility so that we can more appropriately capitalize the SMA as we're scaling. We fund an SMA alongside that private credit manager and ramp the portfolio. So you can't price term liabilities if you have 5 loans in a portfolio. You need to have adequate diversification. You need to have adequate scale. You need to have a pool of assets that the rating agencies can look at and say, this fits our characteristics of what I would deem to be certain ratings. And they'll work with you to find the right par subordination, the right credit enhancements, the right thickness to appropriately size your different liabilities. And then you securitize. So you go out to liabilities buyers and they will purchase these liabilities. It's usually a bidded process for the AAAs, and then the single A here and the triple B is more of a closed process where you go out to a syndicate of traditional buyers and you price those loans. We actually retained the equity tranche in this transaction and the triple B minus rated Class C tranche because it met our return objectives. Particularly we'll opportunistically participate in the mezzanine tranches when it meets the return threshold for our vehicles. So if we're shooting for a 9 to 10% net return for investors within our vehicles, S plus 7 at current base rates on a cash coupon offers a lot of cushion to that number. So I know that was a lot. I see a couple yawns in the audience. I didn't mean to bore you, but I'll end on a couple things of what we're doing today and a holistic solution, something you can take away with that if you're interested. So First Trust, we have an option, or First Trust Alternative Investment Research. We offer solutions across the spectrum from accreditation and liquidity. So on the retail end of the spectrum, daily liquid end of the spectrum, we have mutual funds and ETFs that offer exposure to alternatives. For example, OMOIX is an example of our daily liquid mutual fund. And then on the other end of the spectrum, we offer an OCIO service where we work with around 45 family offices, multifamily offices, and RIAs around the country on advising their alternatives allocation. You may use CASE or iCapital. We have 55 managers on our platform today, not 550. Every manager on our platform today, we have partner capital in. We've invested in ourselves. So we believe in alignment. We believe in we wouldn't put someone else's money in something that we wouldn't invest in ourselves. That's a much more consultative service. It's a QP-only service, but it's something we'd be excited to talk to you about. And then in the middle of the spectrum is our interval funds. These have no accreditation standard. You can have an $1,000 minimum. So they're a very efficient tool for some of your mass affluent portfolios if you're in wealth. They're also a great way to build a core allocation if you're in an endowment or foundation. Or if you're just getting into alternatives, it's a great way to just dip your toe in the water. Today, I just leave you with a couple thoughts on FTPCX, our private credit interval fund. We just passed our 1-year anniversary on the fund, fortuitous timing on when we chose to launch it. We're up about 5.5% year to date. We have a 7% targeted distribution rate, which today is being met fully with income. If any of you'd like to ever jump on the phone and see our income waterfall and see the sustainability of that distribution rate, I'm happy to do that with you guys. So 4 last things to leave you with. Again, offers investors that you may invest for on behalf or advise access to a diversified suite of private credit and structured credit with an $1,000 minimum and no accreditation standard. What does that look like? It's 20% direct investments and credit co-investments across structured credit, asset-based lending, and private credit. And it's 10% exposure to LP investments. So what that is it's 5 investments, 2 private credit drawdown funds, and 3 credit-oriented hedge funds. And then the 70% remaining is in 3 SMAs that we've launched with GPs, which we have primary fund footprints. They're not launching SMAs with anybody else. It's 2 of them are BC Partners and Palmer Square. They're great partners of ours. You may be familiar with them on something else that you're doing in the ground there today. And we think it's a really compelling opportunity to provide investors liquidity, because obviously if you've been investing in interval funds for the past decade, that's probably top of mind as you're putting dollars in the ground today. But it doesn't necessarily, we believe, based on the way base rates are today, it doesn't provide or doesn't contribute overly to the volatility of the portfolio, and it isn't a material drag on performance from what we're able to return within the co-investment and LP bucket. So hopefully that gave you some thoughts on FTPCX. Would love to talk to any of you guys after on anything I spoke about. But really do appreciate you guys sticking around to listen to me and coming out here on a Wednesday to hear about private credit. Thank you very much. Oh, I promised him earlier. I was talking to him earlier. Yeah. Here you go, Vernon.
Thank you, Robert.
Yeah.
Appreciate that very much. And can you tell me about the type of industry concentrations you have right now? And related to that question, where are you seeing what you think are the better opportunities these days from an industry perspective?
Industry is a great question. Private credit, at the end of the day, right, it finances the private equity ecosystem. So if you choose to align with a manager who has to lend into where there is volume, you are going to be lending where there is demand. So if you think about where you have private equity investments today or where you've contemplated private equity investments today, those largest sectors are going to be technology, they're going to be healthcare, they're going to be consumers and industrials. As you move down the size spectrum, the middle market really becomes much more diverse. I guess the best way to think about it is if you took the equal weight version of the Russell instead of the market weight version of the Russell, you'd probably see that the number of companies that fit into different sectors grows. So we typically, the way we invest is typically in the core middle market. I'll say the sort of 25 to 150 million of EBITDA. It's a wide range, but that's kind of what I would say is what we think of as the core middle market. And as far as a sector perspective, we're staying away from, it's easier to say where we're staying away from. There are opportunities in consumer today, particularly within retail, and in asset-based lending, when there's real estate associated with it, there's some compelling opportunities. But consumer-oriented businesses, especially consumer discretionary-oriented businesses that maybe service a lower-income consumer, we're being more cautious about today. But philosophically, the way we think about it is really aligning with the GPs that we have primary fund commitments with, and not getting over our skis in any particular sector allocation. But by no means am I trying to make a macro call and saying that I think private credit investments in tech are going to outweigh private credit investments in industrials over the next 2 months. I think for us, it's much more about building a diversified portfolio where we feel we're getting the best risk return for our dollars.
So do you have any concentrations?
The concentrations in the book today, we do have some energy investments in the book today, probably a greater percentage than you would see elsewhere. We do have exposure to non-ESG compliance sectors as well. So we've lent in the marijuana industry in the past, and we found some opportunities there. But there aren't any, we don't have a 40% tilt to tech. That's just not where we've done a lot today. And I'm happy to get you a more sector-specific breakdown if you're interested in that, if that's an area of concern. Yeah.
Can I ask just a kind of a general question? What kinds of lenders like to take duration risk and which ones don't? And then how does that translate into whether a loan gets a fixed rate or a floating rate?
Yeah, it's driven by what loans the lenders want to put out the door, to your point. Like if you're an insurance company and or an LDI-driven investor, you're a liability-driven investor, and you need to match a longer dated cash flow, a known cash flow that's coming at a known date in the future, you're going to probably invest in infrastructure debt or longer term, longer duration areas of that asset class. From a duration perspective, these are all going to, BSLs, leverage loans, private credit is going to be floating rate in nature. So the duration is going to be roughly the reset period, which is typically a quarter to 6 months. So it's going to be roughly, let's say, half a year of interest rate sensitivity. There are areas of private credit where you'll see fixed rate financing, but it's really driven by the borrower's needs, necessarily than the lenders. If you're an asset allocator and you'd like something longer duration, you're just going to have to figure out which asset classes structurally have longer duration, which tends to be more on the infrastructure debt side, tends to be where you're funding longer duration projects, whereas a lot of these, as I said, are funding a private equity LBO acquisition, which has a timeline of 3 to 5 years, and they're just, most of the time, sometimes they'll hedge the interest rate exposure on their end. Hypothetically speaking, if you made a floating rate loan, you could buy a SOFR floor, or you could put a floor in the loan. If you were concerned about base rates falling, you could fix it yourself by buying a swap. But that's probably not a complete answer for you, but that's just my thoughts.
Is it safe to say that any loan under 5 years is going to be floating rate at issue?
So loans, generally speaking, so BSLs, leverage loans, direct lending, I'd say 95% of that's going to be floating rate.
And does that carry over to private credit as well?
Yes. Yeah, yeah, absolutely.
Kind of from a high level, how do you think about default rates relative to traditional, investment grade corporate bonds or high yield corporate bonds? And then how do you think about default rates within those kind of 5 different kind of vehicles in the private credit ecosystem?
It's a great question, and it's a question we spend a lot of time on. So the easiest way to think about it is there's weighted average probability of defaults that you can get from rating agencies, you can get them from private credit organizations, industry organizations, to get a baseline sort of where do I think the industry thinks default rates are going to be. You can look at sell-side research reports. We take a very conservative approach to it. What we've tried to do in the past is when we look at a new GP or we look at an existing GP that's pricing a new securitization, or maybe we're investing in an evergreen pool or a drawdown fund and we're thinking about default rates. What we do is we look at their entire lending history. So if we're investing with a firm that has a lending history that goes back to pre-2008, so preferably we have someone who's lending since 2000 or at least has experienced some elevated default history in their time period. And we'll typically take that largest period of default for each credit rating, and then we'll run it on a sustained CDR basis or a sustained default rate through the life of the vehicle with varying degrees of prepayments, because prepayments are the other aspect which can change the securitization pool. I would say that obviously typically what we see when it comes to defaults is a large spike in defaults and then a slow taper back to a normalization. So our base case underwriting today suggests that we'll probably see within broadly syndicated loans and leverage loans a default rate, generally speaking, again, there's going to be some manager, generally speaking, in kind of the 3.5% to 5.5% range over the next 12 to 18 months, followed by probably a slow gradient decline back to a more normalized level of 1.5%, 2%. I'd say the managers we invest with, for instance, Palmer Square, just to give you an idea of the dispersion that you're seeing, and you may invest in CLOs already or securitizations already. There's some managers who build CLOs with 3 or 4 or 5% triple C exposure at inception. So that's what they cook when they first put the put the product out. They do that to optimize the excess spread math. There are other CLO managers who believe in optimizing the cost of liabilities by building a much more higher quality pool of loans. So those pools of loans will obviously behave differently. And then within direct lending, middle market direct lending, the easiest way to see this today, and it's already happening, is take a look at BDC non-accruals. So they have to report this quarterly. Take a look at the largest BDCs and see where non-accruals are coming in. I don't want to name names because I'm on camera right now, but there are already plenty of private credit managers that are coming in with non-accruals already this early in the stage of the cycle at 6, 7, 8%. So be informed, read the 10 Qs. That's what I'll say there.
And a follow-up unrelated question.
Yeah.
How do you think about the return correlation relative to kind of traditional credit investments, be it investment grade or high yield?
Yeah. If you're building a portfolio today, it's a great time to do it within fixed income. I don't know a lot of people that can't live on a 7 or 8% sustained return. If you could just tell them, I'm going to make senior secured loans and get you 7 or 8% over the next 5 or 6 years, I think there's a lot of people, myself included, who would take that value proposition. So how do I think about the return correlation in a broader portfolio? If you have fixed rate assets that are long duration risk or long interest rate sensitivity, and you barbell that with floating rate assets, and you think about income, right? So you have a fixed layer of income that you receive from your fixed rate assets and a variable level of income that you receive from your floating rate assets. If the Federal Reserve maintains interest rate policy where we are today, in a broadly restrictive area where we're seeing bank failures, we're seeing non-accruals in middle market at 7, 8%, something's going to break. How they respond to that and what the implications for that are likely means that they're going to respond through some change in monetary policy, which will affect base rates. So in the instance that the economy substantially weakens, I would expect to see base rates fall tremendously. I'm not going to say back to the zero lower bound, but I would expect them to fall. I think that we're creatures of habit, so my own personal opinion is that maybe we end up back there at some point. And in that instance, you're going to see income erosion for floating rate assets that don't have a SOFR floor. So we underwrite a lot of our loans, or the loans we participate in have SOFR floors so that the base rate can't fall below a certain level. You're setting those today at kind of 2.5, 3, which I think is a reasonable level given where the tenor of that transaction. So income erosion on the front end, fixed coupon on the back end. If rates fall a bunch, your fixed rate assets are going to go up in value. And if the economy deteriorates, you'll probably see some price deterioration on riskier floating rate loans on the front end. If you're compensated appropriately from a coupon perspective and you believe in the underwriting that you will experience a loss rate or a default rate below market and a loss severity below market, then I think there's a compelling opportunity to kind of barbell there. Yeah, please.
Thank you. Can you just comment a little bit more on this loss severity concept? I mean, I'm just a equity guy, but if you could talk to me about that as a fifth grader, like we're talking about default rates of 3 to 5% is loss severity, 10%, 30%, total zero. Please elaborate. Thank you.
Yeah, absolutely. So you don't know me. You've never underwritten me. We all just met each other. If you decided to make me a loan today, it would be a risky loan. Not to me, but I feel like I'm a great borrower, but to you, maybe a risky loan. You don't know anything about me either. Yeah, I don't know anything about you either. I could be taking money from the mob. Who knows? But if I don't have any assets and you can't sell my labor, then I have very little collateral for you in the event of a default. Even worse, if you don't have the incentive to put me through a restructuring because of the nature of your capital or how you price the loans within your fund, you may just amend the loan and extend the loan amend and pretend is the industry term, that it'll just get better. All that is to say loss severities, or the percentage of par that you expect to lose in the event of a default, varies tremendously. So if I defaulted on my house today, on my mortgage today, the bank would sell my house and make a profit. So there would be no loss severity, because I keep paying my mortgage and it's at a reasonable rate. And whereas if maybe I took out a 97% LTV loan in California at the height of the property boom there, and I defaulted on my mortgage and someone went to go liquidate that house and say it's a $2 million house in Center City, San Francisco, do you want to test that market today? It's like the loss severity on that may be much higher. So in leverage loans, in the BSL space, covenant light area of the market, I would say typical loss severity for a middle of the road CLO manager is 35-40% through cycle. There's inklings and there's a lot of great research from the rating agencies actually out there about maybe the loss severities in this cycle will be higher because of the nature of the borrowers and the industries that have seen a lot of growth. So it's an area to spend some time on. And then in the senior secured direct lending space area, you almost always see much higher recovery rates or lower loss severities in that end of the spectrum. That is simply because the covenant package is much tighter and they tend to draw in collateral that they're much more confident in the value of, and they monitor it on a much more routine basis. So you may see, just to give you a number, loss severity more like 20 or 25%.
Another follow-up to that.
Yeah.
What's that recovery period? How long is that?
Yeah.
It's great. Or I think about like the Paul Singer Argentina.
Yeah,
thing
right.
Yeah, it's great, but it took freaking forever. Just curious how long these type of things.
Yeah, I hate to give the cop-out answer, it depends, but I've probably been a part of, in our co-investment program, 4 or 5 restructurings over the past 12 to 18 months. And I would say it's typical in a hard asset-based or an ABL-based restructuring for it to go a little bit smoother, depending on the jurisdiction that you're in. So if you're able to gain access to the collateral relatively quickly, the court process is really what elongates this. But once you gain access to the collateral or gain access to the company, the process of in an ABL scenario or hard asset scenario, liquidating the collateral, depends what you're liquidating. If you're liquidating barges that are Jones Act compliant in Louisiana, or if you're liquidating account receivables for a healthcare firm, you're going to have different recovery periods. I would say within a securitization, you'd see typically a recovery rate get paid out up front and then a true up within the securitization. Hopefully that answers your question a little bit.
Just wondering how long, if this is more trouble than it's worth.
Oh, no. So I mean, we've completed, of those 4 or 5, we've completed 3.
Okay.
So in that past 12 to 18 months. Yeah, one took as short as 2 months. One is taking the full 18, and we're on the last bit of pumps and pipes and everything at this point. Yeah.
Do you ever end up with equity in a loss scenario?
In the ABLs, you don't. If you take a business, so if you lend on a mezzanine basis, your security is typically the equity, and you put in, if you're a good mezzanine lender and you write the loan documents right, you put in rights and remedies that allow you to take the equity and essentially control the company. That's where you'll see post-reorg equity. If you lend on a 2L or mezzanine basis, we don't do a lot of 2L or mezzanine lending. What you may see on a senior secured side for some of these larger transactions is take-back debt. So as part of, if you don't think you're going to get the full recovery value, which we have not lost principal on a loan that we've made, but it will happen one day, you eventually you sometimes take a haircut to what your loan is and then accept a new loan at a discount to where your loan was. Those loans trade a little funky. They tend to be CCC rated when you get the take-back debt. But there's actually some really interesting white papers about how those price post take-back period, and they tend to be decent investments. You see a lot of hedge funds buy that paper. So there's a market for it. But your question was, do you sometimes get equity? Yes, if you're in the mezzanine. No, not typically if you're in the seniors or the first lien. Sir?
With respect to this fund on the screen,
Yeah.
what's the subscription process and the reporting details for this fund?
Yeah, so it's daily priced. This is an interval fund, so you can put dollars in daily. It's a 1099 reporting. We'll get quarterly reports. You can get touch points with our team. You give us a call. I'm happy to, if you have a quarterly. Oh, yeah. So like if you have a Bloomberg or, I don't know, what Schwab, Fidelity, they should have yield there. But we have a distribution rate of 7% on the fund today. And then I'm happy, as I said, I can do a liquidity walk with any of you that are interested in the fund on how we're financing that all through income today. So there's no return of capital component, which obviously, as you all understand, sustainability of dividends and sustainability of distributions within these structures. You want to see how much is actually being funded by income and not return of capital, because that may force me at some point to either cut the distribution or sell one of these loans, neither of which would be a good outcome. So something to think about as you're investing in these.
All right, thank you very much. So actually, I have one question, sorry, and this is just for my own understanding. So can you explain a little bit how the mechanism, as far as how these private, credit instruments actually trade? You know, if you're dumping paper, who's buying it? How do they get access to it? Is it kind of a, phone call and you sign some documents? Help me understand that, and hopefully that's a helpful question to some of you.
Absolutely. So direct lending and these private credit loans, by and large, are not liquid. There are a few banks, and because they're banks, I feel comfortable sharing them in this room. JP Morgan makes a market on some of these loans, some of the larger directly originated loans. But it's very rare, and it's a very intensive process where you have to sign, get borrower approval. It's not like point, click, buy kind of stuff. And then there's a few middle market investment banks like Green Sledge, who you may have not heard of if you're not familiar with that space, who started to make a limited market in that space. SMBC is another bank that's made a market in these. But again, if one of you are thinking about selling a directly originated loan, first thing I would do is go to the sponsor or your partners in the transaction and see if they'll buy it. That is the easiest way to source liquidity. There are banks who will make repo markets on this. So if you don't need all of the money, we don't utilize repo within this fund, but there are people who utilize repo within the funds. You can repo some of these private loans with like a 50-40% haircut. So at a reasonable rate, kind of SOFR plus 150, SOFR plus 200.
Okay, no, that's helpful. So thank you, Rob. We appreciate you. It was very helpful and very informative. So really quickly, I'm just going to kind of close out the meeting. So I introduced myself to most of you in here, but I'm David Howard. I'm with First Trust. So I handle some of our larger RIA and institutional business all across the Mid-Atlantic. I have my colleague here, Chris, who a lot of you know, who is local and kind of covers every other channel. But thank you for coming. We appreciate the time. Hopefully this was helpful. I am here. Chris is here. If you have questions, Rob is here. We're going to stick around for a little bit. If you have questions, we'll follow up with the with the slides, and then talk. And if anyone has any interest in this actual fund, we're happy to provide details there and do any follow-up calls. But again, thank you all for coming, and we appreciate the time.